Let's get a bit more philosophical in this video. Let's talk about the system, the capitalistic system, and who actually benefits from this. Because there's obviously winners and losers in a system where capital gets transferred, right? There's all kinds of mechanisms how capital gets transferred. But in the end, there are long-term effects. When you think about this, right, that's at least how I came to certain conclusions. When you think about this, the stock market apparently generates returns of somewhere around 7 to 10% per annum. Yeah, so when you've got capital, 7 to 10% is what you can expect depending on what you invest in. At the same time, your income likely doesn't grow as quickly. Maybe you can reach the 10% if you sometimes do job hopping, etc. But what you're actually observing, if you increase your income actually by 10% per annum, is what you're actually observing is how your career is progressing. You're actually observing how you get better at your job, how you become more productive. But the person that does the exact same job, stays at this position and doesn't move up the career ladder, that kind of person is likely going to see their income grow by less than 7 to 10%. Now, isn't that fascinating? So we can already say, based on that, over the decades, the people that own stocks tend to do better and better over time compared to the people that simply just stay at their job. So that's relatively clear. Now, what we can also see is when we look into this in a bit more detail, when we look at different incomes, what we see is that the people that are at the bottom, in the bottom 20%, their income tends to grow less quickly than the incomes that are in the top 20%. So if you are in the top 20%, your income grows by roughly 5% per annum. If you're in the bottom 20%, your income grows by roughly 4% per annum. And you can see this pretty nicely staggered when you simply just look at the different quintiles. So you go from 20% to 40% to 60 to 80 to 100%. You see that the higher you go relative in the society with income, the faster your income also tends to grow. But still, it doesn't grow as quickly as capital. Now, why do stocks grow that fast? I think the major reason for this is that money expands quickly. So there is the US money supply, right? USM2. And you can check how fast is the money supply growing, how quickly does the US money printer go brr, right? So that's one measure. The other measure is how quickly are stocks rising. And when you just look at the super average stock, so the S&P 500 index, right? What does the index overall do? And you look at that growth rate relative to the money supply growth rate. So the S&P 500 price increases pretty much match with whatever USM2 is expanding with. Now, the S&P 500 is only a price index. It's not a return index. So you get on top also the dividends, but you also get on top the costs and the taxes. So after costs and taxes, you probably are only left in the end mainly with price increases. And that's simply just USM2. That's simply just monetary expansion. So that's another interesting finding, right? So what we now know is that when you're simply just working and you stay at your job, you're going to fall behind because the money printer expands money faster than your income rises. You see this even when you go up further, right? Because money expands again by around 7% per annum, whereas the top 20% only increase their income by around 5%. So it can even be a top lawyer. You can even have $500,000 of income per year, which is top 2% roughly. You would still grow your income slower over the years than capital increases. So the only way out of this whole thing, the only way how to not fall behind is to not rely on income. You have to invest. The capitalistic system, surprise, surprise, favors the people that have capital. So if you don't work on having capital, you're falling behind. Now, the good news is you actually don't need that much capital in order not to fall behind. The average net worth in America is 1 million, which is obviously quite a high bar. You need to be on average 55 years in order to cross the $1 million mark. So the average millionaire is 55 years old. So you've got that. The average net worth is 55, but the median net worth is 200,000. So that's already more achievable, right? So you've got 200,000 is median, so that means half of the population is poorer than that. The other half is richer than that. Very highly correlated with age. So if you don't have the average age yet, don't expect to have the average net worth. But that does not necessarily show us who's the winner and who's the loser. Again, because capital is very concentrated. If you're falling behind by only 2% per annum, because monetary expansion is 7%, and you are in the top 5% of earners, your income grows by 5%, you've got a delta to overcome of 2 percentage points every year. You don't need that much outperformance with the stock market. Now, the problem is that the S&P 500 does not outperform monetary expansion. So the only way to beat the system is to buy stocks or to buy investments that have a higher ROI than those 7%, 8% that the S&P 500 is doing. How can we do this? We do this with technology stocks, and we do this with potentially Bitcoin. You don't want to over-allocate to bonds. You don't want to over-allocate to gold or silver, because those all just keep pace with monetary expansion. Bonds actually, on average, tend to underperform monetary expansion. You don't want to over-allocate to those. You only want to allocate to those as a diversifier, that in case stocks crash, that you've got some money on the side to potentially buy the dip with. But as your primary allocation, I believe it makes most sense to simply buy tech stocks and to buy Bitcoin, and potentially, if your financing costs are low, right, they are below the monetary expansion, they are below 7% per annum, potentially lever up a house, right? Buy a house with 10, 20% down, have the rest in debt, and make sure that the debt is less expensive than how much money is expanding, which usually in most cases is true. But right now interest rates are high, so currently might not be the best time to buy a house. But once interest rates go low again, then you can definitely make that interest rate arbitrage, right? You can have a lot of debt, and that debt tends to devalue faster than monetary expansion. And this is actually how you make money on a house. You don't make money on a house because the house becomes more expensive. You actually make money on a house because your debt on the house devalues faster than monetary expansion. So it's easier and easier over the years to pay off that house. So this is how to escape this. This is how to beat the system. The minority, I believe, beats the system. The minority has a house that's highly levered up, that they pay off over time. The minority invests in tech stocks. Most people just have random stocks that don't tend to outperform, right? If you just have Coca-Cola, if you just have Disney, etc., nowadays, you're unlikely going to outperform. Better have Nvidia, Google, Microsoft, those kind of stocks, right? Have potentially high cap tech stocks that tend to do better, that tend to have monopoly money, as in they have a monopoly within the market, right? They also print money as if it was a monopoly game. But they try to be in a monopolistic market, in a very concentrated market, in a market that scales very easily, in a market that sees adoption, that sees growth that's above the average economy. And if you just divide, say, the price development of the NASDAQ 100 and compare this to the price development of the S&P 500, you see a very pretty nice constant outgrowth. So there was, of course, the boom and bust with the dot-com bubble, but we are talking here now about decades, right? We're talking about our retirement. We're talking about the next 20, 30 years. And in those kind of cases, right, if you're looking at that kind of money and you don't want to fall behind just by earning, because your earning power will become worse and worse relative to the house, relative to the education expense, relative to medical expenses, right? Your income won't grow as quickly, and the only way to escape this is to have enough money. Now, if you invest in the, say, NASDAQ 100, you do beat monetary expansion by quite a bit, actually, by roughly 5 percentage points. So if you're currently falling behind by 2 percentage points, and you can beat the system by 5 percentage points by being a bit in Bitcoin and a bit in the NASDAQ 100, you don't need that much to be invested, right? You have, say, $100,000 worth of income. You're falling behind by those 2 percentage points, so by $2,000 per year. So you don't need that much money in order to make those $2,000 back with an investment in the NASDAQ. So it's maybe 1/3 of your annual income. Maybe if you want to beat the system, half a year of income. If you have that in a mixed portfolio of Bitcoin and NASDAQ 100, you should come out as a winner. This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out. No financial advice, but that's simply just how I personally look at the data. I see that just earning money doesn't cut it. Just investing in the S&P 500 doesn't cut it. Investing in Bitcoin does cut it. Investing in the NASDAQ 100 does cut it. but you have to manage the volatility. You can't panic whenever it crashes. You need to have potentially a plan to buy the dip very heavily in case it does crash. So maybe have some money as well in something that's not correlated, say gold or bonds or just cash, right? Plain cash. But of course, you're losing with the cash as well. So make sure that you have enough invested to offset the loss in cash. And yeah, simply just run those numbers yourself. Right, you know now roughly how much the system is running against you. Make sure that also, in case you've got children, to be aware at least that your children will have it way harder, right? If you're falling behind by 2 percentage points every year and you compound those 2 percentage points falling behind over 30 years, right? Then you're down 50% roughly after one generation. So your children, if they are relatively speaking in the same bracket, societally speaking, right? You become a top lawyer, your son becomes a top lawyer as well, or you're a pilot, your son becomes a pilot as well. And the economy, say for the aviation industry or for the industry of law, doesn't really change. It's not shrinking, it's not expanding. It's pretty much the same part of the economy as it used to be. Then your son, right, your lawyer, your pilot, will have it double as hard to earn the same kind of house, the same size of a house that you had. So think about how you want to potentially support, right? One way, this is how I personally plan to do this with my children, is I don't want to give them the money, right? Because this takes away motivation, this takes away the hunger. But I also don't want them to feel like they have a worse living standard than I do, because then they always feel insecure. I think this is the main reason why there's so few families nowadays, right? Everybody in my generation, or let's say not me, right? But the vast majority of the people in my generation feel like they have worse living standard compared to their parents. And so they always feel like they haven't made it. And so they always feel insecure. And so they always feel not safe enough to have children themselves, right? And so that's why there's so few families now. This is really what I believe is going on psychologically. If your parents had a nice house and they had 2 or 3 cars, and you're still struggling in your apartment, barely making ends meet, then you would never think about bringing 2 or 3 children into this world voluntarily. So this is, I think, what's going on. This is probably why the population is shrinking. And it's the capitalistic system we're in, right? It's simply just because the capital owners, they're the ones that benefit from this. And so if you don't want to have it, that your children have it double as hard as you, if you want them to have it just as hard, then you have to compensate for this, right? The way I do this is I dollar cost average for my children into Bitcoin and into the Nasdaq 100. And my offer will be that whenever they buy a house, that half of the down payment is paid by myself, so that they can then in the end buy a house that's double the size. So that's my approach to this. There's obviously also other things. For example, for education, I believe it's not fair for kids to struggle with paying off their education for such a long time. I personally also had support by my parents. Half of my education got paid by my parents as well, for a different reason, not for this analytical reason, but because my parents were struggling with finances through my studies. So the first semesters were paid by them, then they couldn't pay it anymore, then I had to take out a loan and pay that off. This is then really what gave me the kick in the back to work hard on the side next to the studies. So there is the right amount of pressure for everybody at certain points in life. I believe currently our generation gets too much pressure. I believe the next generation, if the system prevails, right? If there's not suddenly some random currency collapse, etc., nobody knows, at some point these things can happen. If the system prevails, and I think the likelihood of it prevailing is higher than the likelihood of everything collapsing, then next generation will have it even harder. And then you have to think, at least for your specific circle, for the people that matter to you, how to potentially protect yourself against this. Fixing the whole system is probably unlikely going to happen, right? It's unlikely that you and me can change how the capitalistic system works and how just a few winners gain most, right? This is how I believe it is currently. The winner takes most, and that's in investing, and that's also in income generation. That's in many areas of life. And in investing, we luckily can steer this somewhat, right? Simply just by taking the investments that are higher risk. But higher risk is okay if our time horizon is 20 and 30 years, and it's for our retirement, it's for our children, then it's not for, say, the next sports car, right? If we don't worry about the ups and downs in the next 5 years, And we're actually worried about the very long term and worried about not falling behind because incomes grow slower than monetary expansion. If we actually invest for the long-term reason to protect ourselves against the system, then the ups and downs are not a problem. Then they are rather opportunities, right? Then we can rather think of how can I potentially invest even more in case we crash? How can I potentially sell some gold that I've got on the side or whatever it is, right? Generate more income during the dip, have another side hustle, work harder, and buy then the dip harder because then the volatility is actually in our favor. Then it's actually good that it goes up and down because we use those downs more. Hope this was a bit of a food for thought. Feel free to give this a like in case you enjoyed it. Feel free to also subscribe in case it's your first time. And of course, feel free to also join our Telegram. There's a link down below to the Telegram channel. Looking forward to seeing you there. Looking forward to chatting with you. Cheers.